Right. I'm Brett Dedeaux. I'm the chief executive and managing partner of Dedeaux Properties. We're Los Angeles based, and we really cover the prime California submarkets for industrial real estate in Northern and Southern California. Primarily, the really big focus on Southern California, which is noticed by the largest real estate market in the country, with us having the largest ports in the country here. We've been kind of really well known for getting to what's now known in the institutional world as IOS, industrial outdoor storage. We used to really call them transportation oriented properties or logistics real estate. But we do a lot of truck terminals, transloading facilities, trailer yards, high velocity distribution centers, as well as just really typical distribution centers as well. Well, I would say that right now, all the chatter has been about tariffs. And I think that really, within our portfolio, we have at this point, I think we celebrate our 20th year anniversary. We have most of the major logistics and transportation companies in the US within our portfolio. And we spend a tremendous amount of time with the directors of real estate and operations of those companies, as they do with us, because we build facilities really oriented to what they need and vice versa. So it's a collaborative type relationship. And when after this administration was first voted in, a lot of the deals and things that we had probably a little more paused, they were back on again. But with them not really knowing the duration or magnitude of some of these trade policies and the amount of CapEx they might need to put into, let's say it's a 300,000 square foot building that we've got in the Inland Empire. I mean, maybe $35 million worth of infrastructure, warehouse management systems, racking, conveyor systems, and things to that effect. Until they have more clarity, in hiring staff and everything else, they're holding off on a lot of those decisions. So we really see this as where we feel hopefully is a near-term pause as getting more clarity on what the future supply chain is going to look like and sourcing and so on. We really don't think that there's going to be, and talking about a huge fundamental shift in the near term, meaning if you were to start producing domestically what's being manufactured offshore, that's a pretty long-term process. By the time you site select where and determine where you need to build domestically, those same processes, build the buildings, get everything set, redo your supply chain, that's years and years down the road. And so, and again, companies aren't even making that decision yet until they have better visibility to these trade policies. So again, it's more of I'd say a pause. Well, a lot of the move, yes, to these secondary markets, let's call it from Southern California, for bringing in things through the ports of LA and Long Beach, which is where a majority of the goods that flow to the US come in from, and you evaluate Arizona, Nevada, what have you. There is a certain rate, like breaking point when rates get to a certain high. And when rates really ran up post-COVID and during COVID, much higher than really probably was anticipated, it made sense to start taking a look at those secondary markets. But the challenge had always been your transportation costs are dealing with your highest cost of goods sold. And if you're draying, which is taking that's what you call drayage, is shipping your goods out of the ports to that next destination, your drayage cost to go out to those marketplaces is quite a bit higher. And then California, with 20 million people, the most populous state in the country, your outbound's going back in to this market. You just drained your goods out at a big expense. So those real estate costs and labor costs must be significant savings for that to make sense, because those models get run all the time. And that's why Southern California and then Lindenberg grew so much, because the economics led you very clearly to those markets. Well, now with rental rates down 50% or more, actually, most of these companies say, why would I go to the secondary market now with reduced rental rates? It makes more sense than ever to actually be in Southern California, still have a big, large consumer base, a huge population here. And if I talk about a market like a Phoenix, a Dallas, they don't have some of the regulatory constraints we have here, so it is, so therefore being easier to develop. There was a lot of development there, but we evaluated it, we thought, wow, this is more development than what the typical absorption's been. If there's a slowdown, it's going to be problematic. And sure enough, we see a much bigger oversupply in some of those markets where they built quite a bit of supply, more so than they normally absorb. The market slowed, and now they have a significant oversupply. Well, as being a local sharpshooters renowned or operator, right, in Southern California, and with our in-house counsel and development team we have here specifically to make sure that we're on top of the regulatory environment here in California. As an outdoorsman and so forth, I'm a capitalist, but I'm an environmentalist. I love the outdoor environment and so on. So it's really important to us to have projects that are sensitive to the environment and the communities. And really, California's been a leader in that regard. And so already I'd say that we've had AB 98 here, and that puts some additional guidelines on some of the design elements of buildings, particularly if you're in proximity to residential, schools, and other type facilities and so on. So if you have projects that are within those types of regions, you need to relook at some of your future development plans, which we've done. But I think here in Southern California, it's power as there's been a regulatory environment of a lot more electric vehicles, and there's challenges to that because of the capacity of the power suppliers to supply your buildings with the power with especially electric trucks are big power consumers, so it's a big load. But as we're looking now at designing and engineering our buildings, power is much more on the mind, and beyond just the electric vehicles, it's just there's more automation of industrial buildings. They're getting smarter. There's some advanced manufacturing you want to be prepared for. So having that heavier power and things to that effect is good planning, as long as it's because of some of the environmental and regulatory guidelines that have been coming out. But California with Title 24 and things to that effect, again, has been a leader. I mean, that kind of took the place of LEED. And for instance, we actually as a company built the country's first gold LEED certified food processing building way back in 2005, 2006. Quite a bit, quite a bit of what you kind of, I guess, learn from that experience. You take that on to the next projects over time. So I think that out here, you stay, California's more at the forefront there. And as a team, you stay on top of it and make sure you're being strategic with those types of policies. Yeah, in these more, challenging times and things to that effect, as far as you need to be, there is a more vacancy. It's flushing out some of the companies that might have come into our marketplace and not has in-depth market knowledge because of other sub-markets, other areas. And I think this is a time, I think this kind of marketplace favors operators who have a strong history, who have a good background, who have a good tenant base, who can really understand the nuances, regulatory-wise, sub-market-wise, of a business. So I think for capital and institutional capital, it's a good time to make sure. And for us, we want to make sure we're with best-in-class partners and things to that effect, so that we can navigate these waters together.